And what I want to specifically talk about when it comes to change in use is first off to say a change in use was one of those events that we said where there's a deemed disposal. And again, just to be clear, change in use is a situation where you have a property that was either first used for income producing purposes, and then you change the use so that it is now used for a non-income producing purpose, or vice versa. You have a property that was non-income producing use at the beginning, and now you change the use so that it is now income producing. Okay, so where you have a situation like that, you have a deemed disposal, and in this case, the same person has the property or holds the property before the change in use occurs and after the change in use. So it'll, in a change in use scenario, it's the same taxpayer that is deemed to dispose and then is the same person that's deemed to reacquire. So effectively, it's almost like the cost of the property is reset. But again, if there's an accrued gain, you're going to have to pay tax on that. Okay. Now, if you think about principal residence, okay, we taught you guys under the rules that for a principal residence, you must ordinarily inhabit the property for it to qualify. So let me ask you this question. When you have a tenant and the tenant is now living in your property, are you ordinarily inhabiting the entire property? Are you ordinarily inhabiting the entire property when you have a tenant? Yeah. Well, the answer is of course not. How can you be inhabiting the property if there's a tenant in the property? Like if you rent out your basement and the tenant is now living in your basement, how can you argue you're living in the basement? Okay. The answer is you can't. You absolutely cannot. Okay. So now the issue becomes, are you now disqualifying the entire principal residence because you're not living in the entire property, or do we artificially carve up your principal residence? So for example, let's say half the tenants live in the basement, you're living in the top floor, and it's a 2-floor property. Do we now argue only 50% of the property qualifies and that 50% does not qualify? Or do we argue the entire property is disqualified? Which one do we argue? Is it the entire property that's disqualified or just the part that is being rented out? So that's an interesting question, because if you think about it, the Act, when you read the principal residence rules, so if you go to 54, so why don't you turn to 54 for a second. So if you go to the definition of principal residence, which is on page 260, so if you, again, read paragraph A. So again, it's on page 260 in your Act. Read paragraph A. Does it say part, or does it just say property? Like, is it making reference to a part of a property when you read that? What's the key word? If you read paragraph A, how can you argue only part of the house is disqualified? How do they describe the principal residence in paragraph A? Like, what's the key words? No, so not where they're inhabited. That's about what do you qualify. But we're not just talking about how do you distinguish between part of a property or whole of a property as being your principal residence? How do they describe the property in paragraph A? Housing unit, yes. So think about it this way. What is a housing unit? Okay. Is it not the whole property? Well, what the act and what basically how people have interpreted this is saying, well, if you now rent out part of your house, in effect, you've shrunk your housing unit. Okay. So yes, the rules in its wording arguably does contemplate this type of situation. But the key thing is you're deemed to dispose. And I wanted you to think about this, for example. In Vancouver, say you bought a house 10 years ago. How much of it has increased in value? Is it a substantial increase in value, or is that a little increase in value? Pretty big. So what was the issue around the presentation? The issue was if you have a tenant, you have a change in use. It's not a do you have a change in use, right? Because unknowingly for many people don't think about this because all they're worried about is how do I afford my mortgage? So they just go out and they say, oh, everyone uses a mortgage helper. So let's get a mortgage helper to afford the mortgage payment. But what a lot of people don't realize is, in effect, you're in business. You're going out there renting your property. You're no longer living in that space. So you've, in effect, reduced your housing unit. You have a change in use. Okay? And I need to clarify, if you buy a house and you rent it out from day one, all that means is that's not a change in use anymore. It just means in day one, you have a house that is partly principal residence, partly rental property. Okay? But in many cases, you buy a house and you're living in it, and then maybe over time you convert the basement into a rental property. Well, now you have a change in use. Okay? And that could be pretty significant. Okay? So the question was, and this is what we were trying to get at in the presentation. The question was, we know you have a change in use. There are consequences with that. But are there circumstances where the CRA will ignore the change in use? Will they say, from an administrative point of view, will you ignore, you go, CRA, will you ignore this? And what CRA said was, we will accept that as long as the renting is ancillary, it's an ancillary use of your house, meaning a secondary use, then we'll ignore the change in use and we'll continue to accept that the whole house is a principal residence. And in the past, it was never clear what was ancillary. So before this stuff came out a couple of years ago, people were being told, or people were being advised by lots of people out there, hey, you know what? If less than 50% of your house is rented out, that's ancillary. You're not going to have a change in use. Okay? So a bunch of people started converting their basements because they're like, hey, you know what? There's a shortage in the rental property market. Hey, my kids moved out. I don't need, why don't I use this opportunity to make some extra money? Some people were like, you know what? Oh man, it's expensive out there. Why not I convert my property to a rent, convert my basement to a mortgage helper so I can pay off my mortgage faster, right? So what people didn't realize was they had a change in use, and then some people thought, well, it's less than half my property. Oh, I think I'm okay. And they installed separate entrances. They put in plumbing to facilitate a kitchen downstairs. And then CRA a couple of years ago came out with this views document. And it was huge because if for those who read that views document, a typical views document talks about, oh, taxpayer, you sent me this letter and etc. This was not like that. People did not, there was no, some taxpayer sent in the letter and the CRA is writing to say they're responding to the letter. Instead, what happened was this was more a response to an audit query. So in other words, someone in the CRA asked a question of their technical group, and CRA decided to release the views. Okay, their view on the topic, they decided to release that view to the public. Okay, so this views document said, ancillary means you did not make any structural modification to the house. So not only is it maybe less than 50% usage, you also had to not have made any structural modification. And that was a game changer. That was huge because before people thought, oh, it's just about space. And the answer was no, you can't have done work to modify structure. So if you put in a separate entrance, if you put in plumbing for a kitchen, all that automatically makes your rental suite offside, and now for sure you have a change in use. Okay, does that make sense? So that was the part, that was a key part of the presentation, was change in use. You got to pay a tax. For your information, by the way, by a lot of people out there, you're screwed. And then the question was, well, when are you not in trouble? And the answer was, well, in what circumstance do you rent and not make a structural change? Well, the answer was, you have a homestay student. Because in the homestay students, they just live in your house and they have free access to your entire house. That is by definition what a homestay student is. Well, in that case, you don't have a structural modification, right? So again, if you rent less than half your house to homestays and there are no structural modifications, then generally speaking, you're probably okay. The problem is in BC, that's a very small subset. So most people in BC are screwed. They're not going to be able to retain principal residence. If you buy a house and it's already been designed to accommodate a mortgage helper from day one, and you're intending to rent it out, then the argument is you didn't buy a whole principal residence. Only part of your house is a principal residence. If you had a place where you converted and you did structural modifications, doesn't matter what percentage of the house, that portion you're renting is no longer a principal residence. You're going to have a change in use. Okay, so that was a big ruling that came out. And the key thing was, well, there are elections that maybe you can use to try and save yourself from the consequences. Well, back then, these elections were not available on partial properties. You had to change and use the whole property. And that was a big deal. So when this ruling came out, there was no way to save yourself from these change in use deemed disposals. You had to declare the capital gain and pay the tax. And the views showed that it was an item that was actively being audited. And you might say, well, Chris, why is that? Why are they doing this? Well, the problem was when people yelled and screamed about housing in BC, they were saying, oh, go after those foreign buyers. It's those damn foreign buyers that you got to go after. And so CRA said, fine, we will create a team, a project team, and they will be solely dedicated on auditing principal residence issues. Well, the problem was They have to look at everything. They don't just look at foreign buyers. They're going to look at all aspects of principal residence. And so people who are thinking, oh yeah, damn those foreign buyers, let's go after them, unknowingly, they actually created an audit team that was also going to go after them because they were in violation of the rules. And the team has to go after all violators, not just select violators. And so they kind of they unknowingly created a task force that would also enforce these other rules. And so that's kind of the climate in terms of where this was created. One other area that this has affected is assignments. People have always complained about assignment flipping. So does anyone know what an assignment is when I'm talking about assignments in BC and condos? Does anyone know what the issue is there? So assignment flips. So say you buy into a condo pre-sale, right? So some company, they're going to build a condo tower. They're trying to get people to put money up front and sign on to a purchase agreement. So you buy into a pre-sale. Before the pre-sale is complete, you can still sell your contract to someone else. So in effect, you can sell your pre-sale to someone. And when you do that, you have to do what they call an assignment. You have to say to the condo company, hey, condo company, yeah, I entered this contract to buy this unit from you, but you know what? I'm selling this contract to someone else now. They're going to take over the ownership of the unit when you're complete. And so you have to assign the contract to that other person. And so people sat there and said, well, hey, this is great. Like housing in BC is so expensive. I can flip these contracts and I can make money. So the government said, well, under a whole bunch of rules, if you do this, the gain on the sale of the assignment contract is not a sale of principal residence. And furthermore, it is 100% taxable, not 50%, because this is now a business-like activity. And again, that was part of what this force was created to do. And the way they enforced it, they went right up to the condo companies and said, hey, BOZA, hey, Mosaic, all you companies that build these towers, give me a list of all the assignment contract requests you've seen. We're going to audit everyone, and if that person has not recognized 100% of the gain in income, we're going to go after them. So the task force that's right now going back and vetting through a list and then starting to reassess taxpayers and go after taxpayers on that basis. So you may have heard of someone that's gone through this, you may not have, but they are going through the list, and it's going to take them time because it's quite a few people, but they're going after people who have done multiple flips first, then they may go after people who've done 1 or 2 flips. And they are making arguments based on negligence, meaning they can go back as far as they want because they're saying people are negligent when they make these type of errors, which I can understand. So anyways, those are some of the things that just came out of this presentation or came from as you know, that are related to the presentation that you guys may be interested in. Yes, Airbnb, again, that's an income producing purpose. That is a change in use. Yes. Again, Airbnb, are you living in the property when you're renting out the room? No, you're not. Right? So Airbnb is a change in use. They are fully entitled to go after you on that. Now, could you argue maybe somehow that you can try and be like a home state? Maybe. But again, with Airbnb, if you're you'd think that you'd be adding locks to the door. You really would think that you would want separate entrances because you wouldn't want all these people to have regular access to the rest of your home. So again, Airbnb, yes, that would be a change in use. Does that make sense, Abdurazak? Yeah. Fun times. Now, so let's talk about more change in use. If you have a change in use and you're dealing with an asset and it's a depreciable asset, the question becomes, well, how do you deal with this? Okay, so how do you deal with this? So if you have an issue with change in use, under 13.7b, what it says is you dispose of an asset, therefore you'll have to, so let's say, for example, you go from non-income producing to income producing. So take a car, okay? Or like take a truck, okay? You spend $15,000, okay? And let's just say, for example, because this case, pretend it's Don Cherry, right? He's a celebrity. So let's say after people find out that he's the one that used the truck, the fair market value of this truck went from 15 to 25, okay? And Don Cherry says, let's just use this truck to go on these tours and meet with fans and get paid for appearances. So he starts to use it for a business purpose, okay? So now you have a change in use. You have a truck that you use personally. Now you're going to use this truck to drive you around for business, for appearances, and so now it's being used for business, and the value increased. How you determine? Remember, change in use. You're deemed to dispose. You're deemed to reacquire at fair value. Okay. So the issue is, I'm deemed to dispose of the truck for $25,000. I'm deemed to reacquire at $25,000. Okay. So now the problem is, what do I add to UCC? Is it fair to add $25,000 to UCC? Okay. And think about this for 1 second. Okay. Just like replacement property, right? If you look at this truck, you would say, hey, Chris, this truck, okay, I paid $15,000 for this truck. Okay. Now it's worth 25. All right. So I do a change in use, right? So then change in use, non-deemed to dispose. Okay. So first off, he's going to have proceeds of 25,000. Cost is 15. Right. So at the end of the day, you'll say, Chris, hey, I'm going to have a $10,000 capital gain. Okay. I'm going to have a $10,000 capital gain, of which only 50%, right? Only 50% is taxable. So at the end of the day, I'm only going to have a $5,000 taxable capital gain. Okay. So now his cost base is now going to be $25,000, right? Because he's deemed to dispose. Don's the one who holds the truck after the change in use that triggers the deemed disposition. He's acquired to acquire a fair market value. Now the ACB is going up 25,000. Well, if I put 25,000 to UCC, is it fair? Because what happens to the 25,000? How much CCA do I get? Again, this is very similar to replacement property. What is the value? How much CCA do I get? Well, I'll get 25,000, right? Not zero, 25,000. Well, what's the problem with this? Well, I paid 15,000 and I get taxed for 5. But I get to put 25,000 in CCA. So at the end of the day, you only committed 15,000 up front, and you only got taxed for 5. So that's like $20,000. That kind of has some sort of, you're on one side, but on the other side, you're actually getting a free $5,000 of CCA. Is that fair? Government said, no, I don't want to give you free CCA. So what did the government say? ACB is $25,000 for purposes of calculating capital gain. And then the government said, we need to create a rule that says we're going to pretend cost for UCC purposes is different than cost for purposes of calculating capital gain. Okay? So the government said, guess what? If capital gain is only 50% taxable, what are we going to do? We are only going to add the taxable portion to UCC. Okay? So in other words, what the government said was, hey, look, because only 5,000 is taxable for UCC purposes, we're going to say cost plus the taxable portion of the gain is $20,000. Okay? So this is cost for UCC purposes. And that is what you get in the form of CCA in the future. So this is supposed to equalize the consequences that you get from the deemed disposal versus when you acquire and you can put these assets into UCC. Does that make sense? Okay. So that's the backdrop of change in use in general. So now the question becomes, all right, I have a principal residence. What does that mean? I change in use my principal residence. Doesn't that mean I don't have to pay tax on the deemed disposal? And the answer is yes. You don't have to pay tax on the deemed disposal because you can claim principal residence exemption. Then someone said, but what happens if in principal residence, what happens if I'm not going to leave Canada for a short, I'm going to leave Canada for a short period of time. So what happens if someone said, if just for whatever circumstance, just for a short amount of time, I need to change in use the residence, but then over the long period of time, I'm going to be back in the house. I'm going to be living in this principal residence for the vast majority of the time. Hey, government, can you give me a rule that gives me some relief? So the government said, all right, if I do a deemed disposal and you have, yeah, you might be able to exempt some capital gain, but it feels like we're going to punish you later because now there's some years which you can't designate as a principal residence, and maybe the house is going to increase in value over time, but in concept, you're really, over the long haul, you're really living in this house long term. Maybe we need to put in some rule for some relief. So the government said, we're going to create some special rules around change in use for principal residences because some of these consequences might be unfair. So in the week 9 contents, there's this deep dive change in use handout. So this change in use in principal residence deep dives revised format. And there's 2 areas that we've talked about here. There's 2 tabs. The first tab talks about what happens when you have a change in use and you're doing it on the entire property. Okay, so here's an example. You have a house in 09 in Kelowna. Some part of it is building, some part is land, and you plan to use the house as a vacation property. And then he decides to rent the property in 2017. And at that point, the fair market value increased. And what's the tax consequence with the change in use? So again, just looking at the property, not looking at claiming CCA or anything like that, but just looking at the property, the question would be, on the building, you have your capital gain. On your land, you're going to have your capital gain. Okay, so there's 100,000. Like if it helps, there's my tax. So there's my capital gains. Okay, 50% taxable, and then in BC, just to facilitate the discussion, how much tax are you paying on your change in use? So in this case, we're going to pay $260,000, 61,000 total. Okay, but the whole point is here is based on the fact pattern. When you change in use, you normally have your capital gain. And then again, based on what you can now put into UCC, what was my original cost? Well, it was 100,000. Well, what's the taxable portion of the capital gain? Well, it's 100,000. So therefore, the UCC after change in use is only 200,000 for the rental property. Okay, and you have to remember, we talked about this, right? Why does all this matter? Because when you're calculating CCA, you cannot create a loss on rental property, right? We talked about that way back in week 4. Okay, so now the question is, okay, government, here's a scenario. I've got $261,000 tax bill from changing the use. That seems really prohibitive. Is there anything we can do to get some relief? And the government said, we're going to introduce what we call change in use elections. Okay, so 45.2, 45.3 says where you have a change in use, you can file these elections. And here's the key. We are going to pretend, okay? We are going to pretend the change in use didn't occur. Now you sit there and say, well, Chris, this seems silly. Then what's the whole point of these change in use rules if you can pretend they don't occur? Well, the answer is, if you file this election, say you're in this situation, you're Jerry. You file this election and you say to the government, I want to pretend that this property is still being used for non-income producing purposes. So then what happens? Can you claim CCA? No, you can't. Do you still have to recognize the rental income? Yes, you do. So for the government's point of view, if you decide to file this election, you're going to have rental income and you can't claim CCA. You're going to have more rental income. And by the way, the rental income gets taxed at 100%. So the government's view is, well, if you file this change in use election and you're really just renting out the property for the long term, because you're sitting there and saying, well, I want the relief, but you're renting this property out in the long term. Government's actually saying, hey, we're better off because you're not going to be able to claim CCA. I'm going to get more tax. So this election only makes sense if for the short term, you're renting out only for a short period of time, not for a long period of time. Okay, does that make sense? Are you guys following me so far? Okay, so the government said, so number one, this is indefinite. In terms of how long do we ignore the change in use? Well, we ignore the change in use forever. So that means once you file this election, forever, Jerry can't claim CCA. Okay, you can't. Now the question then becomes, all right, so we file this election, no deemed disposal, there's no capital gain, okay? But what that means is, for cost base, the land and the building, these cost base do not change. You sell the property later on, the cost base is still going to be 100 and it's still going to be 150 for the land. Okay, so 100 for the building, 150 for the land. That's still going to stay the same because you said we pretend that change in use didn't occur. Okay, now what happens though if at the end of the day you now said you file the election and then you sell the property in the future? Okay, so let's say, for example, in example 3, you purchase a home in 2009 in 2017, you changed in use, but you filed the election. So you said, hey guys, property is now worth 1.3 million, but I filed the election, no change in use, no deemed disposition. But then later on in 2023, you sold the property. And at that point, the property is worth 2.4 million, 600,000 building, 1.8 million for the land. What are the tax consequences if Jerry wants to maximize his principal residence exemption? So here's the issue. You take a look at this and you say, well, Chris, 2009 to 2017, okay, he lived in the property every summer. He ordinarily inhabited the property. But 2017, in the middle of 2017, Jerry says, oh, no, you know what? I'm going to rent this property out. And in effect, he stops ordinarily inhabiting the property since 2017. And now you sell 2013, right? So the question becomes, well, how much principal residence exemption can I claim? And you have to remember, you've said, I filed this election in 17. This is a non-income producing property. So can I still claim the principal residence exemption? Okay. So the answer is you can, because again, principal residence, you have to designate every year, right? So you're going to designate 09, 2010. You're going to designate some of those years as principal residence. But the special thing about this election, because remember, this was intended to give you short-term relief. If you did not rent this out long-term, you just rented this for short-term, the purpose of these rules was not to penalize you for just renting out short-term. So this is what the government said. When you file a 45-2 election, you will get up to 4 free years for your principal residence designation. So what that means is for 4 years, even if you did not ordinarily inhabit the property will still qualify as a principal residence. Okay? And when we talk about direction, it doesn't matter. If you have a non-income producing property and now you change the use to an income producing property, 45(2) says that change in use does not occur. You file what we call a 45-2 election. If you have a property that is income producing use, then goes non-income producing, then you file a 45-3 election to say that property has not undergone a change in use. So again, income producing to non-income to income producing, 45-2 covers that. Income producing to non-income producing, 45-3 covers that. Okay. So where this has occurred and you file these elections, you're going to get 4 free years. So how does principal residence work in this case? Number one, you do what we've taught you before. Calculate the gain upon the disposal. Okay. So again, because you filed the election, you use original cost basis. Okay. So there's your capital gain. There's your taxable capital gain. Then the question becomes, how many years can you designate a property as the principal residence? So you sit there and say, how long have I held the property? Well, I own the property from 09 to 2023. So I've owned the property for 15 years. All right, now how many years did I ordinarily inhabit the property? Okay, then the answer is, well, I lived in the property, or Jerry lived in the property from 2009 to 2017. So he lived in the property 8 years, plus the initial year, so that's 9 years. Okay, so 9 years total. Now you get 4 free years from the election. That's 13. So you sit there and say, well, that covers 13 years out of the 15 years. So I can designate it so that 13/15 is a principal residence. Now I add my free year. So 14/15 is exempt. And so now I can exempt 93.33% of the capital gain when we sell ultimately in 2023. Okay. in 2023. And the key thing now is very recently, very recently in the last year or so, the government filed or proposed a new rule that says these change in use elections can occur even if a partial portion of the property has changed in use. This is very key. So where you have a change in use and it's only partial property, 45.2 and 45.3 will now apply. Okay? Before, so depending on how long you took this course, before 45.2, 45.3 did not apply for partial changes. You had to change in use the entire property. Back when CRA wrote that guidance, that new guidance, 45.2, 45.3 did not apply for partial change in uses. But in the last year or so, the government wrote a rule in to say now you can apply 45.2, 45.3 for partial changes in use. Okay? Does this make sense? Does this make sense? What we've talked about? This whole 4 free years. And just to give you guys a sense of where these rules would never penalize you, imagine you worked at a public accounting firm like a KPMG or a Deloitte, and you get a secondment. So say, for example, you got a house, a condo here in Vancouver. Now KPMG says, hey, I give you a 2-year secondment to work in Tokyo. That's what a friend of mine got. So you go to Tokyo and you work there for 2 years. Well, in those 2 years, it doesn't make sense not to rent out your condo. Right? You're not occupying the condo. Why not make some income out of the condo? If I leave it unoccupied, I'm going to get hit with the home buyer's tax, right? That speculation tax or whatever that tax is, right? So they sat there and said, well, I might as well rent it out, earn income, and avoid the tax. Well, in the case of 45.2, now, when you come back, you're not going to be penalized, right? And you have to remember, too, Jerry changed in use in 2017, okay? But you notice here, we included 2017 in the years he ordinarily inhabited. And that's really key. Because he did live in the property part of the year, it doesn't matter if he changed the use in that year. You basically, the 4 years happens after that year. Because that particular year, he changed in use that he did live in the property earlier in the year, so he still qualified it normally. Okay, so the fact, that's an important fact when you look at these things. Okay, so that's change in use for principal residences. Okay, so again, this handout goes into it in a lot of detail. This is something you are responsible for in the course. Partial change in uses. This is going to be in your homework. And this is what I call a homework supplement. So this is one of those things where what I want you're going to get a question and it's going to really make you focus on this piece. When you are dealing with partial change in uses, okay, what is important is you have to pretend, you have to be able to subdivide the properties into multiple pieces to visualize the change in use. So say, for example, we give you a question, 20% is non-income producing, 80% is income producing, okay? And what happens is 20% in 18 is going to be converted from income producing to non-income producing. So in this example, what we've shown you here is, here's 80% income producing, right? And just to help visualize the concept, we've said, hey, let's separate out this 20%, okay? Because this is the part that's going to go through change in use. This part is the non-income producing piece, okay? So again, we said at the beginning, purchase price, $725, $500 relating to building, $225 relating to land. So we've taken the 500 and we've segregated the 500 into its portion. So 20% is 100,000, 20% 100,000, 60%, 300,000. So the 500,000 has been subdivided between these three portions. Same thing for your land. 225 was the cost, 45 here, 45 here, 135 here. Okay. Now, when you go through the change in use, we tell you, oh, fair market value is now increased to 815, 585 to building, 585 to land. And the key thing is, when you go through these partial change in uses, you sit there and say, well, proceeds, remember, change in use, deemed to dispose at fair value. Well, remember, only 20% has changed. So you have to sit there and say, well, what's 20% of 585? That's what this is going at, is what the 117 is. And down here, this is how we showed the 20% portion. Okay. I should increase the size a little bit more. Okay. So when we had the change in use, that's the 117 right there. That's how we calculate the 117. Same thing for the land. The land, what is 20% of the new value of land? Land is now gone up to 230. So what's 20% of 230? Well, that's 46. So you have your deemed disposition. And again, your cost, once you do this deemed disposal, there's your capital gain. That's the new cost for capital gain purposes. Okay. When you go down here and you look at UCC, at the very beginning, okay, 80%, right? 80% was income purpose. Okay. And remember, this is 2017. So remember, AII rules do not yet apply, right? AII, you had to have your addition November 21st, 2018 and beyond. This is non-eligible in 2017. So we did half-year rule, okay? Now we come in 2018, now you have a disposal, okay? And remember, cost is lower than proceeds. So you show your disposal and it affects your CCA, okay? And again, it's a negative net additions. There's no half-year rule or AII, right? Or AI bonus, because you don't have any net additions. There's no bonus to apply for. There's no half-year rule to apply, okay? So at the end of the day, you do your deemed disposal, you show the effect on CCA, and here's the key. When you deal with multi-year partial change in uses, you must always recalculate your tax attributes at the end of the year. And this is very crucial. When you look at tax doesn't look at how did you break up. They don't sit there and say, oh, third floor is income producing, second floor is non-income producing, basement is income producing, and you have 3 properties. No. Tax just says this. No matter how you subdivided the uses on your property, at the end of the day, you will always have at most 2 properties within a particular building. You will have a non-income producing property and an income producing property. So it doesn't matter how the layout is, which rooms or whatever, you only have 2 properties within the building at the end of the day. And you have to combine your non-income and your income producing pieces. So when you are recalculating your attributes, you need to just show there's 2 properties, okay? And then you go into 2019. And now in 2019, there's another change in use, okay, in this example. So in 2019, sorry, I know this is going to get, the entire building is used for an income producing purpose. And again, the fair market value has increased. Okay. So now, because you've recalculated your end position by combining your non-income producing pieces, now you can go and do your calculations. Okay. In terms of your change in use. Okay. So again, 40% change in use, so 40% of the new building fair value, 40% of the new land value, okay? And again, now when you do your calculations, Now I have AII because it's 2019. Okay. And again, when you figure out your additions, remember, cost was 217 and the taxable portion of my capital gain was 17.5. So even though 252 is a new fair value, I do not add 252 to my UCC. I only add 234. Okay. And if you sit there and say, Chris, when could I have used principal residence to nullify my capital gain? Well, it's right here. When I converted from income, sorry, in this case, I could never have nullified using principal residence because I'm now going income to non-income. So here, when I go through the change in use here, now there's an argument that maybe if this was my principal residence, maybe I could use principal residence exemption to exempt the gain. Okay. But typically in the homework, we're going to ask you to ignore principal residence for now because we just want you to focus on the mechanics of the partial change in use because it gets complicated. Okay. So what I'm going to say to you guys is I've run through what's in here, but it's important that when you do the homework, look at the handout and try and break it down to all the little pieces. Okay. Because this is all about how do you manage the detail as you go through year by year by year. Okay. So that's all I want to say about this one for now. Okay. Any questions? I know this might be tricky to follow. And this is one of those things where I'm probably just going to quickly explain it now in class, and then you'll need to digest this a little bit. But this is, to me, it's not too complicated, but again, you need to spend some time. No questions? Okay. Then I'm going to move on. Actually, I'm going to just close this right now. Sure, why not? And I'm just going to close this. Okay. All right. Our Canadian tax system. So the last part of the lecture is more about just the general administration of our tax system. For those of you who have taken 3410 over a year ago, I think it's now over a year ago, this material is new. We never in the past talked about the Canadian tax system in this detail, but because of the fact that 3410 and 4410 are two separate courses, a decision was made that we should go into these items in more detail in 3410. So this is new if you've taken the course over a year ago. Okay. So in our system, I think one of the things you have to understand is there are obligations that are put on taxpayers. And more importantly, there's timing. They put requirements on when you have to pay installments and when you have to pay your final tax bill and when you actually have to file your tax returns. And because there are different taxpayers and different requirements, typically there are a number of different returns that are required to be filed. Okay. On top of that, you have not just income tax to worry about, but you have GST and PST, right? So you have different type of taxes that you have to worry about, and each tax needs its own return. to ensure that you are paying your fair share of tax from the government point of view. So you have to remember, and again, way back when we talked about things, right? How are we taxed? We said there's income tax. Then we have what we call transactional taxes, like what we call value-added taxes, okay? Like GST, okay? Then there's general transaction taxes, like your PST, your property transfer tax, okay? And then there's user fees, right? So there's all these different taxes, okay? Now, when we talk about filing obligations, okay, what we call filing obligations, what returns do you have to file? If you're an individual, okay, you are required to file what we call a T1 individual income tax return. Okay, so the returns that you guys file every April 30th, you know, by April 30th normally in every year, okay, that is T1. Corporate tax returns, those we call those T2s. Okay, so the T2 corporate tax return. Trust returns, if you're a trust, remember, trust is a separate person for tax, you must file a T3 return. Okay, and by the way, when I'm going through these, we are not going to talk about the COVID extensions. Okay, COVID extensions are these very temporary, one-time event type extensions. Those are not meant to be permanent. They're only in place to address the circumstances around COVID. The rules that we're going to talk about the normal filing deadlines and normal like payment deadlines. Okay. So just please keep this in mind. COVID is not covered in this course, and we are not going to teach the COVID extensions. And part of the reason too on that is COVID extensions, the government is constantly changing these timelines because they're trying to respond to this pandemic. So even if I were to try and teach you COVID extensions, the reality is those might not be the final extensions. So whether we're actually going to teach you the right rules or not is kind of up for debate. So all I'm going to say to you right now is we're only going to teach you the normal rules, no COVID related rules. Okay. Also, other entity types may have returns to file, but they're not like your normal income tax filings. Okay. So filings like partnership returns that do not require taxes to be payable, we call these information returns. So in other words, these returns are being filed because it allows the government to make sure that individuals, corporate taxpayers, and trusts are reporting the right amount of income. Okay, so just so you know, there are what we call income tax returns, and then there are information returns. When do you have to file the T1? Okay, your T1 individual tax return. Number one, if you owe tax, you have to file a T1. Number two, if CRA comes to you and says, hey, you guys need to file, then you need to file your T1. Three, if you're trying to report a capital gain in the year, you need to file a T1. If you dispose of capital property in general, you need to file a T1. Or if you have CPP, EI, or you're trying to claim a pension income split, which I think they'll talk more about in 4410. Okay. If you're trying to split pension income, you need to file your T1. Generally speaking, if you're an individual, there's no reason ever not to file a T1. Even if you say, Chris, well, I have a nil return, why bother? Basically, when you file a tax return, then you start what we call the statute bar clock. And we'll talk more about it in a second. But the statute bar clock basically is the amount of time that CRA has to review a return and consider any reassessment. So generally speaking, if you're an individual, in most circumstances, it makes sense to just file your T1 even if you don't have any income to report. Because you never know if something's been missed and there'll be consequences. So filing T1 earlier kind of makes it easier. When our T1 tax returns due, if you are an individual, most people, it's April 30th. If you're a regular person that just works a job, it's April 30th. Okay. If you are a self-employed individual, so you're someone where you are earning business income, right? Like for example, I work for CPA Western School of Business. I earned a couple thousand of business income as a self-employed individual, as a contractor. Well, then I have June 15th as my filing deadline. Okay. Now, someone said, well, what happens if someone dies, right, in the year? Okay. Right? Because remember what I said before, when someone dies, what happens? Well, they're deemed to dispose. But what also happens? Well, you're no longer living. So your year end for tax purposes is now the day that you died. So now the question is, when is that return due? So what the government said was, if you are someone who has no business income, so in other words, you are not a contractor, you are not carrying on business, then you have, and you died between January 1 and October 31, then it's April 30th. If you died after October 31st, okay? So if you died after October 31st, then there's some different rules that you may need to look at, okay? If you are a self-employed individual and you die between January 1st to December 15th in the particular year, then it's June 15th that you have to worry about as your filing deadline. Does that make sense so far? Okay. Now, what happens if you didn't die within these timelines? So you're April 30th, you didn't die between January 1st, you died after October 31st. If you're a self-employed individual, you died after December 15th. What happens? Well, then you have 6 months until after date of death. Okay. So then you have a called variable deadline. Okay. Okay. So you have an individual dies May 15, 2019. What's the due date? Well, their due date, they're between that January, October 31 range. Deadline will be April 30th. If they die January 20th, 2020, and they've not yet filed their 2019 tax return, then the due date will be 6 months from the date of death, July 20th. Okay. So these are just some examples. So it's a little bit more tricky, right? It's not just, oh, did they die? Did they die between October 31st and December 15th? No, the answer is, did they die between, if you look at the second example, the issue is, oh, this person died after October 31st. And, oh, by the way, they have not yet hit their filing deadline on their tax return, and now they died. Well, guess what? They will get 6 months from the date of death. Okay? So it's a little tricky because it's not just within the calendar year. You have to kind of look at what's their filing deadline. Did they die? Did they die before the filing deadline? That's kind of part of the things that matter. Okay? Does that make sense on some of the technical trickiness on the date of death? Okay. Installments. So you have to think about, you're the government. You need money throughout the year, right? You don't just need money at April 30th. You need money throughout the year. So how do you make it so that individuals pay their gives you money during the year? Well, you say to people, well, you need to pay installments, okay? And the key thing about installments is, just think about it. If you're the government, people are prepaying their taxes, right? So it's almost like the people are lending you money, right? But the beautiful thing for the government is, when you pay installments, they don't pay any interest. right? The tax is not yet due, but you're paying installments. You're paying the government interest-free money. Okay, so the funny thing is, most accounts, they'll say to you, good accounts will say to you, hey, if you have a tax amount owing on April 30th, that's not a bad thing. That means you did not give too much interest-free money to the government in the year. In fact, if you have a refund, most people with most tax accounts would tell you that's a bad thing, because that means you gave money to the government for free when you could have taken that excess dollar, put it in the bank, and earned interest. Okay, so it's not necessarily a terrible thing if you owe tax at the end of the year. But the key thing is, when you have installment requirements, you have to make the appropriate amount of installments, or the government will charge you interest. So it's always a fine balance. You want to pay the government enough that as the minimum you're required, but at the same time, you don't want to pay them too much, because then you're not earning interest on money that you could have earned interest on. Okay, so installments is kind of like there's a fine balance. Okay, now most people out there will just be like, whatever, I'm just going to pay what CRA tells me to pay so that I don't have to worry about it. Okay, but if you're someone who's trying to min-max your situation, then you're going to want to know the rules around the installments. Okay, so how does installments work? First off, there's a threshold, and the threshold says if you owe government more than $3,000 net tax in a year, then you're going to have to pay installments. Okay. Okay, and the key thing is, first off, in the year, if you're over 3,000, and if you had net tax owing in one of the 2 preceding years. So for example, pretending that 2019 is the year we're dealing with, in the 2 preceding years, did you have a net tax owing balance of $3,000? And do you have a net tax owing balance in the current year? Then if the answer is yes to both of those, then you should have made installments. Okay. Also, of course, if you work for an employer, the employer is automatically deducting payroll withholdings, because that's a requirement. So when we're talking about installments, for people who are working a regular job, we're talking about installments in excess of what you do through your payroll withholdings. Okay, so just to make sure that's clear. So when you do installments, there are always 3 methods that you can choose for doing installments. You can either take your current year estimate. So in other words, you sit there and say, okay, based on the numbers that I know of this year, I think I'm going to pay X amount of tax. You can take that, divide that by 4, and you pay them on these 4 days: March 15th, June 15th, September 15th, December 15th. Okay. Or you can say, I'm going to take my preceding year's tax balance, whatever amount that I was owing in the preceding year, and divide that by 4. And I pay it on those 4 days. Okay. Or I use the combination method, which is to say, take the tax amount owing in my second preceding year. Okay. So for example, let's say I'm doing my 2019 tax return, because again, under COVID, some of you guys might not have even filed the 2019 return yet. Take your 2019 return. My second preceding year would then be 2017. My preceding year is 2018, right? So under the combo method, it says for the first 2 payments, take whatever you owed in 2017, my second preceding year, divide that by 4. And that will become the payment for my first 2 payments in 19. Then it says for payments 3 and 4, look at the amount owing in 2018. Okay, take that amount, back out whatever was paid in your first 2 payments. Take that remainder, divide that by 2, and then those are the amounts you pay in 3 and 4. Okay, and the key thing here is, no matter what, whether you use preceding or combo method, the total amount you pay is always equal to the preceding year's tax. So in the case of, if you're dealing with 2019, the total amount paid will always equal the total amount of tax owing in 18. Okay? Does that make sense? Here, maybe we should go through an example. So let's go through an example. So let's say, for example, you have an individual, after, again, excluding payroll withholdings, after payroll withholdings, they still owed 2,000 tax in 17, they had still owed 4,000 tax in 18, and now you believe you're going to have 8,000 owing in 19. So the question becomes, did you meet the criteria for installments? The answer is yes, because again, you had over 3,000 owing in 19, that's what you estimate, and on top of that, in one of 17 or 18, you had a year that was over 3,000 net tax owing. So 18 was 4,000, that's over 3, so therefore you are required to do installments. If I then look at the methodology, under the current year method, you would have to make 4 payments of $2,000 because 8,000 divided by 4. Under the preceding year method, you would have to make 4 $1,000 payments because again, it's 4,000 divided by 4. Under the combination method, what would happen is, okay, CRA says $2,000 was what you owed in 17, divide that by 4. So it's 2 payments of $500. So you would have paid 1,000 total. And then for third and fourth payments, oh, now I know what amount is owing in 18, 4,000 less 1,000 paid. And then I would pay you'd pay $1,500 for the last 2 payments. So total will still be 4,000, but the distribution or the allocation of your payments is different. Okay? And basically, as a taxpayer, you are free to choose any of the 3 methods. It's up to you. But here's the key. If you choose the current year method and your actual tax bill is greater than what you estimated, you will have to pay installment interest because the government will say you did not pay enough installments. If you use the preceding year or the combination method and the final tax bill is higher than what you would be required under those methods, the government will not charge you installment interest. Okay? So you will never, as long as you follow the preceding or the combination method, you will not be charged interest if you follow them, even if the final amount is greater than what is owing. Any questions on that so far? That's right. And of course, when you're doing this, the presumption is, when I make that comment, the presumption is you're saying you're following current year method because that number is smaller than the preceding or the combination method. Okay, so the presumption is you're always trying to make the least amount of payments as you can. Okay, so when I make that comment where you will always be charged interest only on the current method, the presumption there is you're following the current method because it's cheaper than following preceding year or combination year. And that's the case. Like in real life, people who are actually trying to figure out what's the best method, they would have calculated all 3 methods and then chosen the lowest one. Okay. And again, remember, why is it designed this way? Why is the combination method designed this way? You have to remember, say you're dealing with 2019 installments. Remember, 2018 tax returns, the due date, if you're a self-employed individual, is June 15th, right? So remember, your payment schedule says you need to pay installments March, June, September, December. So By the CRA says, I won't know for sure what your final tax bill is in the preceding year until after June 15th. That's why the combination method says, look at the first two payments are the second preceding year. Because again, you've got quite a bit of time to file the prior year tax return, right? Again, 2018, I have until return. If I'm self-employed, I have until June 15, 2019. So for my 2019 installments, government doesn't even know what my 2018 tax was until after June 15th. So that's why their notices always follow the combination method. Okay. Does that make sense? But again, you still have preceding year method if you choose to use it, or you have, or you have the current year method if you want to do a tax estimate. Okay, so that's for individuals. Okay, what about corporations? Well, when do you have to file a corporate tax return? Well, you always have to file a corporate tax return. There's no option. It's just you're a corporation, you have to file. So you have a nil return where nothing happened in the year because it's inactive, doesn't matter, you have to file. You have to tell the CRA if the corporation is inactive. Okay? Now, what happens in terms of filing? Individuals, you can e-file. Most people e-file their returns because it's most convenient, etc. Some people paper file. Okay? For T2s, you must e-file if your gross revenues are over $1 million. Okay? So you don't have the option. Individuals, if I go back here, okay, I can't remember if I put this in here. Individuals, they're generally not, I don't think I have it in here. Okay. I should have put it in there. Anyways, individuals, the government is generally not as fussed because first off, they're getting installments automatically through payroll. And the individual amounts are not as bad. But generally speaking, they encourage individuals to e-file as well, regardless. Okay. But for corps, there are strict requirements. If you're over $1 million gross revenue, you have to file. You have to e-file. Okay. Also, they have an option which we call the functional currency option. So what that means is, let's say you're a Canadian business, but because you sell mainly to the US, you track your numbers in US dollars. You can tell the government, hey, government, I want to file my return in US dollars. So all my numbers are US dollar numbers. That's what they call functional currency option, okay? So you have that option if you're a corporation. Also, when's your due date? Again, the due date for the return is 6 months after your year end, okay? So in other words, you must file 6 months after your year end. Now, here's one thing that's very different between corps and individuals. Individuals, if, for example, you pay installments and then your final tax bill is higher than your installments, you have to pay that amount by the filing deadline, by April 30th. So individuals, the date in which the final balance of tax is owing, so which is your actual tax bill less what you paid in your installments during the year, your final tax bill, that amount is due at the same time as the filing deadline. Okay, so that's individuals. Corporations, because the government automatically gives you 6 months, they have different rules. Okay, and the other thing is corporations, especially profitable corporations, have much larger tax bills than individuals. So the government basically wants their money from corporations sooner than an individual. Okay, so how does corporate installments work? Number one, you must pay them monthly. Okay. Number two, so you don't have four payments in the year like individuals. You got to pay it every month. Number two, you have to pay them if tax payable in either current or previous year is $3,000. Okay. Second, installment amounts, again, you have 3 methods, but of course now you're dividing them by 12. So current year estimate over 12, preceding year over 12. And then the other kicker in the can is for combination method, the second preceding year is only used for the first 2 payments. The last 10 payments of the year is still used, is based on preceding. Okay, so again, combination says take a look at your second preceding year tax paying or tax owing, divide that by 12. That's the amount you pay for the first 2 years. Then for 3 to 12 payments, 3 to 12, take the preceding year taxes less what you paid in the first 2 payments, divide that by 10. That's what you pay for the rest of the year. Okay. So for public corps, imagine you have a situation, 2017, you owe tax $60,000, 2018, you owe 19, and you estimate 120 in the current year, right? So under current method, you pay 10,000 a month. Under preceding year method, you'd pay $7,500 a month. In the combo method, you take your 60,000 over 12, that's 5,000 a month for the first 2 months of the year. Then for payments 3 to 12, okay, 2018, 90,000 was owing, less your 10,000, okay, divide that by 10, now it's 8,000 a month for the last 10 payments in the year. And again, total amount you're gonna pay, combo method is 90,000, same as the preceding year method, okay? Does that make sense? It's mainly just a bunch of formulas. I just want to just double check here. Okay. Anyways, why is it, just so you know too, why is it that for second preceding year or combo method, it's only the first 2 payments in the year? For most corporations, okay, again, for most corporations, if you have a balance owing, so again, you look at the installments paid during the year and your final tax bill, you have to make that final payment by the end of February or by the end of the second month, okay, second month after the end of your tax year. So for example, if I have a calendar year end for a corporation, right? So for example, Ford has a calendar year end, okay? And we're talking about 2018. That means for 2018, I have to figure out what is my final tax bill by the end of February. If that final tax bill is higher than the installments I paid, I have to make that final payment in February. And so the funny thing is, even though my tax return is not due until 6 months after December, until June 30th, even though the filing is not done until June 30th, government says you have to pay the final amount you think you owe by February. So there's always this timing differential that you have for corporations that you do not have for individuals. Okay? So just keep that in mind. That's why combo method only is 2 months for second preceding year. What if you're a CCPC? You're a small Canadian controlled business. You tell the government, I'm trying to grow. I need my cash flow. Can you help me? So the government said, if you're a small CCPC and your taxable income is less than $500,000 and your working capital from a tax point of view does not exceed $10 million in the current or previous year. So in other words, you are truly a small CCPC, okay? Then, and you claim some amount of small business deduction, which again, you're going to learn more about this in 4410. You claim some amount of small business deduction in the current and previous year. And you've had perfect compliance in the last 12 months, meaning you've not screwed up any of your tax compliance in the last 12 months. Then the government says you can just pay on a quarterly basis. Okay? So again, if you're a small CCPC, then current year divided by 4. Your previous year method is, of course, again, whatever you tax you owe in the previous year divided by 4. Your combo method, again, it's 4 payments. Only the first payment would be based on the second preceding year, and then And then your second, third, and fourth installments would be whatever you paid in the previous year less the first installment. Divide that by 3. Okay. So again, if we go through an example, let's say you had 20,000 owing in 17, 30 in 18, 40 in 19. Again, current year method, 10,000 a month. Oh, sorry, not 10,000 a month. That's really bad. 10,000 a quarter. Okay. When I say month, I really mean the monthly payment. It's 10,000 per payment. 7,500 for the per payment for the second, and then for the third, again 20,000 for the first payment, then, or sorry, 5,000 for the first payment, then 8,333 for payments 2, 3, and 4. Okay. Maybe I shouldn't use the word month. That might be misleading. It's really meant payment for that month. Anyways, so that's small CCPCs. Trusts. We're not going to spend too much time on trusts because to really talk about them in detail, then we're gonna have to talk a lot about the nuances for the trusts, and we don't have the time. So trusts generally, if you have taxes owing, if you have anything where you dispose of capital property, again, demand notice, or you have a capital gain, then again, you need to, and by the way, sometimes where can you have a taxable capital gain, but not dispose of property? Imagine you owned a mutual fund. Say you invested in a mutual fund. Mutual funds are a trust. And let's say the mutual fund sold something and they distributed a capital gain to you. That's a situation where you can have a capital gain in a trust or in an individual's return, but not dispose of any capital property. Okay, so if you get a distributed taxable capital gain, again, that's going to cause a filing requirement. So again, filing deadline, it's 90 days after the end of taxation year. Well, what is the end of taxation year? Well, a lot of it depends on the trust. Many trusts will use calendar year, but graduated rate estates, these are the estates that are created upon death, they will be more dependent on, those will not necessarily use calendar year. Okay. Again, we don't want to go through all the too much rules on trusts. Trusts are kind of funny because technically they have the same installment rules as individuals, but CRA doesn't really enforce it. So they don't really force trusts to do the same thing as individuals. And the reason they don't typically is because in many cases, people don't keep income in trusts. And the reason that is because for non-GRE trusts, the income if you keep it in a trust is typically taxed at the highest possible rates for individuals. So you generally don't want to keep income in a trust. So that's why typically CRA is not as fussed. Okay, that's in general. Again, we're not going to go into all the nuances. Interest and penalties. What happens if you don't pay the amount that you're supposed to? For individuals, if you owe to the government, it is prescribed, and you might remember Reg 4301 bracket, right? Reg 4301, when we talked about the loan rules. We had that table, and I said to you, well, there's that benefits column, which is the base rate, and then there was refunds and penalties. So if you owe an amount to the government, the interest rate will be prescribed rate plus 4%. If the government owes you money, then the amount is prescribed plus 2. Okay, but the key thing is you're going to pay an interest rate of prescribed plus 4 if you owe money to the government. That's for interest. Penalties. Generally speaking, it's only on large amounts. Well, what defines a large amount? So you have to look at this formula under 163.1. Okay. So this formula basically is what the penalty is, and it kind of defines what a large amount is. This formula you just have to memorize. Okay. So that's all I'll say on that piece. So this one, again, just need to memorize. If you're a corporation, here's the fun part. If the government owes you money, you just get prescribed rate. You don't get 2%. If you owe money to the government, it's still prescribed plus 4. Okay? And then if you're a corporation, then what they do is they sit there and say, if you're a small corp, you're going to get the same kind of rule as individuals. If you're a large corp, and they define that based on your taxable capital, then we're gonna apply an additional penalty based on the corporation's taxable capital. And they'll do that for a period of 40 months. So they basically sit there and say, well, let's look at look at your taxable capital for 40 months, and then we're gonna hit you with the penalty. Okay. Again, these are just memorization things. Due dates. Again, we said April 30th is the due date for individuals. Okay. If you have balance owing, here's a key thing. If you are a business, say you have you're self-employed and you have business income, even though you have a later filing deadline, your final tax bill is still owed April 30th. So again, you're going to have to try and estimate what your final tax bill and pay that to the government if you have not yet finalized your numbers by April 30th. Okay? And you might sit there and say, well, Chris, well, doesn't that mean that I have to file by April 30th? No, you still can file by June 15th. And you sit there and say, well, why does that matter then? Well, when government determines penalties, the penalties are based on did you file on time or not. Okay? Interest is you didn't pay enough to the government. Penalties typically are about did you file on time or not. Okay? So that's I think that's the key thing to understand. So these due dates are the due dates are really important for determination of penalties. The due dates for balance owing is totally dependent on just affecting interest. And again, as I said before, 2 months for most corporations, you have 2 months to pay your final tax bill, even if you have a filing deadline that's 6 months after year end. If you're a CCPC, you get a little bit more time. You get 3 months. Okay. And again, information returns. Again, some returns are considered information returns. T3s, if you have no tax owing, then it's like an information return because you still have to tell the government what you've distributed to the beneficiaries of your trust. T4s, like the slips that you guys get for preparing your tax returns, those are information returns because that's information that the employers report to government. Again, T5s, slips that you get, say you have investments in a company and they pay you a dividend, or you have investments in a mutual fund and you get a mix of interest, capital gains, and dividends. Then these are information returns that companies or mutual fund companies have to file. Okay. Generally speaking, you must keep 6 years. You must keep your books and records for 6 years because in case of CRA audits. And when you file a return, CRA acknowledges they've received your return through this notice of assessment. And here's the key thing. What we call your statute bar clock, the time that CRA has to audit your return, that clock starts when they issue you an acknowledgement of receiving the return, which is this notice of assessment. Okay? If you have changes that are made to the return after you have filed and after the CRA has acknowledged receipt, then you may get what they call a notice of reassessment, which is to show, hey, there's a change to your return and here's the consequence. Okay? How long does the CRA have to audit? Normally, for individuals, trusts, and CCPCs, the government has 3 years. Other corporations, for example, a publicly traded corporation like Fortis, government says they have up to 4 years to audit. Okay? And then in certain instances, they can have an extended period to audit. For example, if they see fraud or negligence, then there's no statute bar period. They can They can audit for an unlimited period. So for example, the assignment stuff I talked about, they would probably argue they have an unlimited period to audit. If the taxpayer signed a waiver, meaning you say government, I know you need more time on this specific issue. I'm going to sign a waiver so that you can have more than the normal 3 or 4 years. Okay. So those are some examples. That's not all inclusive, but that's some examples. Okay. Government also has a rule that's called the GAR rule. They call it general anti-avoidance. And this rule is in place because let's say, for example, someone does a transaction and they said, hey, government, I get this tax result that is really great. I get to keep it because I did everything all within the words of the law. And the government says, hey, if you can think of a situation that we didn't anticipate and you are, in our opinion, abusing the tax rules, even though you are keeping within the word of the law, in effect, we believe you violated or you're abusing the spirit of the law. Then we're going to apply this rule to deny the benefit. An example of this is what we call the Quebec Shuffle. Years ago, the Quebec government, in its bid to be individualistic, said to companies, you can have a different year-end in Quebec than you do elsewhere in Canada. In government and in corporations and tax advisors figured out that you can abuse this because you can manipulate when income is recognized in Quebec through various means, and you can actually end up paying less tax overall because of this of how the rules were structured. And so then Quebec cried foul, government cried foul, because overall you were kind of taking advantage of Quebec's arrogance to pay less tax. And so then they applied GAR. So that's kind of a very basic or general example of GAR. Okay. But we're not going to go too much into GAR, but again, these are kind of the criteria. You have to have saved tax. There has to be what they call an avoidance transaction, something you did purely to save on taxes, and there must be abuse. Okay. Last thing I kind of want to talk about some goods and services tax stuff, GST, PST. GST is a transaction tax, same thing as PST, but the difference is GST is only a tax that is generated on additional value. And more importantly, companies or vendors can claim input tax credits that to recover GST that they pay on their inputs. And what this really means to you guys is the cost to the vendor in the GST world is a lot less than PST, because PST, you can never recover it. Once you pay PST, it becomes part of the cost for any particular purchaser. Okay, and this is why back then when they had this discussion, should we have HST, should we have GST and PST, right? When the provincial government went back from HST to GST, PST, businesses were like, that is the stupidest thing anyone could have voted for. It was ultimately the dumbest thing I could ever see happening. Part of the issue was people didn't trust companies when it came to the HST. People were thinking we're going to get cheated. But the dumb thing about it all was HST in its entirety is a VAT. And the reality is, by lowering the cost to companies, you ultimately would have savings in terms of price. And yes, HST did broaden the base, because now, for example, certain things where you had never had PST on, like restaurant meals, all of a sudden HST would apply. But on balance, HST by far was better for most people. And the thing too was, for the province, when you factor in the government money that they would get for adopting HST, when you look into the fact of simplicity and less compliance costs, etc., it was probably, in my personal opinion, the dumbest thing that people ever voted for. But let's explain the mechanics so you can understand why I'm trying to say that. Say, for example, you have GST or HST. Okay,
and we're just looking at the GST right now. So you're a manufacturer, you buy something, it costs you $10,000. You're going to pay $500 of GST. Now you sell something to a wholesaler. Okay, you sell that, you sell 20, it costs you 25,000. Like you sell for 25,000. So the wholesaler pays 25,000. They're going to pay you, the vendor, 1,250 in GST, and you're going to remit that 1,250 to the government. Okay, but at the same time, you're going to, as the wholesaler, okay, you paid 1,250 to the manufacturer. Manufacturer took that money, gave it to the government, but you paid. Sorry, I'm mixing things up again. Let me start all over again. Yeah, I'm getting tired. So you say you're the manufacturer. You manufacture something. You sell something to a wholesaler for $10,000. Wholesaler pays $500 of GST. Manufacturer takes that GST, gives it to the government. Okay, so wholesaler has paid $500 of GST. Now wholesaler is going to sell something to a retailer for $25,000. The wholesaler, for their purposes, cost is only $10,000, because even though they paid 500 GST, they're going to get the $500 of GST back. Okay, they're going to get this $500 GST back. So, and then they charge retailer $1,250 of GST. So the net amount the wholesaler is going to remit to the government, the formatting's off here, is $750. Okay, so they remit net $750. So they've recovered the $500 that they originally paid. Okay, now you're the retailer. Again, your cost is only $25,000. Why? Because yes, you paid $1,250 GST, but you're going to get this $1,250 back. Okay, now you sell this for $50,000 to a consumer. Well, now you're going to sit there and say, okay, I'm going to charge the end consumer $25. I'm going to net remit to the government $1,250. Okay, so total tax paid overall on this transaction is $2,500 from cradle to grave. Now you look at PST. PST, again, is a transaction tax. Once you pay it, it is part of your cost. Okay, so imagine, in each side, right, the wholesaler says, so manufacturer sells for $10,000. Okay, and let's just pretend PST is $500. Wholesaler pays $500 PST. His cost is now $10,500. So now let's say he wants to earn a 250% markup. He's going to sit there and say, well, I got to apply 250 to 10,500. That means now I'm going to charge $26,250. Again, if I go back here, if my cost for sure is $10,000, 250% markup is only 25. But because it is now part of the cost, 250% of 10,500 is 26,250. So now I'm going to charge this tax on 26,250. Now I'm going to charge my retailer $13,1250. But now you're the retailer. I want 100% markup. Well, my cost is not 26,250. It's 26,250 plus this 13,1250. So now my cost is 29,562.50. Okay, so now this is a problem, right? Because or sorry, not 29, 27. Yeah, I'm just saying 27, 562.50. So now I want 100%. 100% of 27,562.50. That's going to give this 55,125. And then I'm going to have to charge 5% on this new selling price, and that's 27.56. So total tax being charged is 4,568.75. Again, in the GST world, 100% markup, I only have to charge $50,000 if I'm the retailer. So as a consumer, you're going to pay a higher end price because effectively at every stage you're paying tax on tax, right? PST is being charged on top of PST that was previously charged. So because of that, you end up paying a higher amount of tax. The issue in the GST, PST, HST debate that people never understood perfectly was HST is a fully transparent tax. You can see the final amount of tax being paid on the final bill. PST is a non-transparent tax. Because it gets incorporated into the cost of at each level, you don't really see the final amount of tax that's being paid. So people never understood that in the HST PST debate, which was very unfortunate because now it's much more costly to have this additional tax to administer. Any questions on that fact? Does that make sense? Okay, I'm running low on time. If you don't owe tax, do you need to file by April 30th? The answer is you should. If there's an error later on, the government come back to you and hit you with penalties if there was an error. And also, if you don't file on time, the government may come back to you and send you a demand notice to file, and then you need to file. So generally speaking, there's not a great excuse not to file by April 30th. Normally. Okay, I'm not going to go too much further because we're running over time. So again, all in all you have is here are the rates, okay? And the big thing about it, who pays the tax? Again, every recipient of a taxable supply shall pay the tax, okay? And we talk about the recipient, it's very broad, okay? So there's this stuff here is kind of some examples of what matters. Here's the last thing that you have to understand. How do you figure out whether or not GST or PST applies? When it comes to tangible goods, the question is, where did it get delivered to? If say you buy someone from an Ontario vendor, they ship it to you in BC, then you have to pay PST GST, okay? If for example, you were living in Ontario and you buy something from BC, so now the vendor ships it to you in Ontario, then they have to charge you HST. Okay, so that's an example. It's based on where the goods are delivered. If it's real property, then you look at where it's located. So again, if you buy real property in BC, then again, GST is at 5%. You don't do HST. If you're buying property in Ontario, regardless of where you're located, then it's HST. Okay, and again, for services, it's based on where the services are used. Okay, and finally, GST, again, the magic number is 30,000. So if you have 30,000 per year in revenue, then there's a requirement to file for GST. Okay. So this is the rules on there. Okay. And again, it's a monthly filing. If you hit 6 million sales, if you're between 1.5 and 6, it's quarterly. If you're less than 1.5, it's annual. Okay. And generally speaking, it's 1 month deadline to file, unless it's annual, and you get 3 months. Okay. And again, same thing. It's as kind of as the other rules. Okay. So payment is due when returns are due. Again, there's installments and all that. So that is it for this lecture. Hopefully everyone is fine. I'll talk more about the midterm next class. And again, we'll look at wrapping up the course next week. Anyways, that's all I want to say. Unless you have questions, feel free to stay and ask. But other than that, thanks guys for the lecture. And Claudia, I'm just going to wait here for a minute or two, and then I'll set up a private room to quickly chat with you about